What's the difference between an FHA and a conventional mortgage? We'll break them down so you can decide what's best for your situation. Hi everyone, Chris Egan, Berkshire Hathaway Home Services. In today's competitive real estate market, it's often hard to decide what's the best loan product for you. There's oftentimes a lot to consider. Not only what is best for your personal financial situation, but also what implications will that loan have in terms of the real estate purchase. So here's Levi with Prosperity Home Mortgage to break down the two most common options, conventional and FHA.
Hi, Levi Sukup here with Prosperity Home Mortgage. When you're buying or refinancing a home, the two main loan programs are an FHA loan and a conventional loan. Today we'll look into the differences of each. First, we'll start with an FHA loan. An FHA loan is backed by the government and typically has a down payment of at least 3.5%, unless you're pairing it with a down payment assistance program. See video above for more information on that. Interest rates are typically lower on an FHA loan than a conventional loan, and they're actually the same regardless of your credit. Mortgage insurance is also cheaper on an FHA loan and is actually also the same regardless of your credit. Since the interest rate and mortgage insurance are typically lower on an FHA loan, this means your payment will likely be lower as well. The credit score requirements for an FHA loan are a little bit lower. They actually go down to a 580 credit score. And this opens the door to homeownership for people that have had issues with credit in the past. The income guidelines are also a little bit more lenient on an FHA loan, allowing for a higher debt-to-income ratio. Now on to the cons of an FHA loan. The biggest con most people see with an FHA loan is the fact that mortgage insurance is required for the life of the loan, regardless of how much equity you may have. For this reason, most people end up refinancing their home to a conventional loan once they've reached 80% loan to value, or 20% equity. There is also a funding fee with an FHA loan. Now this doesn't increase the amount you have to bring to closing, but it does increase the amount you have to pay back. The funding fee is 1.75% of the loan amount, and that is simply added on to your total loan. Many realtors don't like FHA loans due to their stricter appraisal requirements. Any peeling paint, bare wood, or unsafe deferred maintenance is typically required to be repaired before closing. Many realtors also feel that a buyer using an FHA loan is also not as strong as a buyer using a conventional loan. Although that's not always the case because some buyers simply opt for an FHA loan due to the lower interest rate and the lower mortgage insurance. The last main downside of an FHA loan is the fact that it can only be used to purchase a primary residence that you intend to live in. You can't buy second homes, vacation homes, or investment properties with an FHA loan. Now on to conventional loans. These loans are not backed by the government and are conforming. What that means is they conform to the guidelines of Fannie Mae and Freddie Mac. The down payment on a conventional loan typically falls between 3% and 5%. 3% down is reserved mainly for people that are first-time homebuyers. You can also use a down payment assistance program with a conventional mortgage. See the link above for more info on that. On a conventional loan, the mortgage insurance does get cheaper if you have a larger down payment and can be completely avoided if you put down at least 20%. On a conventional loan, there is no funding fee, and you can also use a conventional loan to purchase a second home, vacation home, or even an investment property. Typically, realtors look at offers using conventional financing to be stronger than offers using an FHA loan. The main reason behind this is they feel like the borrowers themselves are stronger financially, and also there's less strict appraisal requirements. The cons for a conventional loan start with the fact that they are a little bit more strict on their guidelines. You do have to have at least a 620 credit score in order to qualify for a conventional loan, and also their debt-to-income ratios are a little bit more strict, meaning you could have a little bit less buying power. Mortgage insurance and your interest rate are impacted by the credit score, so if you have a lower credit score, that may increase how much you're paying on your rate and your mortgage insurance, thus increasing your overall payment. Therefore, it's good to compare a conventional loan to an FHA loan to make sure it fits your specific scenario.
Thanks, Levi. And of course, if you have specific questions about your individual situation, feel free to reach out to either Levi or myself. Thanks so much for tuning in to another video. And of course, don't forget to like and subscribe.